Okay, so if you look around this area right here, let's clean it. Somebody was asking the question, B that when the price went below the B, but if you look around here, it's probably a wave within a wave. That was an impulsive wave. If I should fib around this area, I want to be clear as to why price went lower. A correction right there, corrective wave. We moved down, break of structure, came above it, and now we have our spring. If you look around here, everything that was happening was clearly divergence in play. So that was a wave within a wave that you looked at. And if you go on smaller time frame, you're probably going to see it even clearer. Now, nobody should tell you the next time that you come back and see Euro NZD flying up around this area, don't be surprised. The reason is you have a completion of a full wave. And you are clearly seeing the Elliott wave with its corrective move happening. And the sad thing is, this is a harmonic pattern. If I look at this, I clearly know that is a harmonic pattern. And what harmonic pattern is it? Is a shark. Most of the time, from your corrective wave, the patterns that you're going to see is a cipher or a shark pattern. The reason why, personally, I almost or most of the time my trades are cipher patterns is because of this reason, because I love to trade a corrective wave. The end of the full Elliott wave, I want to be able to take this trade and be able to ride it all the way up. So when people ask me, Francis, what's your favorite pattern? I just tell them cipher. But then the ciphers need to be establishing themselves in a particular way for me to take them. I'm not going to be taking cipher trades when it's happening around here that I know that is going to give me just about almost a TP and it will drop. When I see my sharks or cipher here and even price is driving down, I am going to stay in that trade. Because the reward that will happen afterwards is better than the drawdown that I'm seeing. Now look how the harmonic pattern is formed within the wave. If I look around this area, it's the same situation, look. Harmonic pattern. What pattern is this? Another cipher. Look around this area. What pattern is this? A shark. If I look around this area, what pattern is this? A shark. Don't ask me about the ratios yet because I'm just showing you how they are formed within the waves. And this is why it's important to understand the wave, to know which pattern is going to play out and which pattern is not. If it's not lining up with a very positive wave, you know you have a corrective wave. The next thing, hitting your D, you're going to get a corrective wave. So you know that in this way, you're taking a TP at TP1 and leave the rest on the table. Hence why people are able to take trades holding to TP. Oh, I'm holding to TP2. By the time they realize stop loss hit. The question is, in which wave are you sitting in? Is this helping somebody? Give me a 2 in the chat box if I'm making clear sense. This is actually helping you to understand some of the common mistakes you've been doing. All right. Now I am going to finish it off with one of the confirmations that you need in order to take your trades, which is an imbalance. How many of us on this call are not aware what we mean by imbalance? Give me a 3 in the chat box if you are not aware what we mean by imbalance. All right, so what do I mean by imbalance? Imbalance in the market really means pure bias price action. That is that's the simplest language I can put it in. Pure bias price action. What do I mean by that? If it is a buy, you're only going to be seeing buying price action. If it is a sell, you're only going to be seeing purely selling price action. And the most significant thing about this is that you're not going to be seeing clear wicks touching each other. So if you look around these areas of the market, pay attention to here. The wick over here is overlapping the third candlestick. The wick over here, look at that. Look at the space which is being left around this area. So that wick is not touching any of this wick area. So clearly in this candlestick, it was purely buying and no selling. Purely buying and no selling. So in this area, I can identify my imbalance as the space around here and there. And guys, look at what's happened. The space that was created around this area, because it was all buying, price came back into that same area, and now the sell has occurred before another buy. This area is what we call an imbalance. Have I explained myself right, guys? If it's not clear, make me aware. I will go over it again. Okay, so I'm going to use another example. Look around this area. Let's focus our attention from the top around this area. The pricing from here to there, everywhere the wicks are beating each other. From this wick into that wick, we're touching. From this wick into that wick, we're touching nicely. But if you look around this area, the impulsive candlestick that occurred, all this space is fully sells and no buys. Nobody is doing a business here in a buying formation. And what that particularly means is that that wick right here, this last candlestick before this impulsive candlestick, the wick is not touching the next wick formation that occurred. So in between this space is where we have the imbalance. Now I can put it as this. If I stretch this way, clone it all the way down, and drag it to the next area, the last wick, which is this one. So everywhere in this space is an imbalance in the market. Let's shade it a little bit darker. Once again, everywhere here is an imbalance in the market. Is it properly explained now? And look at the way it fits in perfectly with all the waves that are being formed. How crazy that is. We have an impulsive move, an imbalance created, price come back and fill the imbalance. From the imbalance, it moves to the next imbalance. Oh my God. Once again, look around this area. Look around this area. Same scenario. This candlestick right here, between this candlestick, there was an impulsive move that occurred, and this wick is not touching that wick. Now let's create another imbalance section and see what happened. So if from that wick, we move it higher. Let's clone this, move this down to the next one. So this is the imbalance zone. Look at that. We came back, filled the imbalance, and price dropped. Once again, look around these areas. Look around these areas. Pay attention. I'm going to zoom in for you to see clearly what is happening. Look around this candlestick right here. This candlestick. Pay attention to this candlestick right here. And the move that happened down here. Indeed, we tried to come back and fill some of the imbalances. However, it wasn't fully filled. So there is still the space which is still laid here. So between this area and that area, there's still a space. I'm going to stretch this. I'm going to stretch that a little bit to 600. And now let's look on the left side what happened. The same imbalance that occurred. Look at how price came back, filled the imbalance, and dropped. Did I create this? So you're asking me, how would you be able to identify where your correction is going to finish? These are some of the confirmations that you need. Your correction is always going to finish inside an imbalance or another one, which is inside your institutional candlestick. That is where it's always going to finish. And it will be in the premium area. The premium area is what I spoke about as yesterday. You always have to take your trade from a retracement and not a correction. Am I making some sense here? How crazy is this? Even look what happened here. There was an imbalance around this area. Because if you look around here and there was an imbalance here. I'm going to stretch it out and show you what happened. Look at how many times we traded into the imbalance dropped, traded into the imbalance dropped. Imbalances are key, guys. They are key when it comes to market structure. We don't like that to happen. The Forex market is not a cheat. It wants to divide the market so fairly. If buyers are getting the share, eventually sellers might get the share. Let's show some more. Somebody might be thinking, Francis, you've probably pre-planned this session and you wanna beat our minds a little bit. But no, we're not buying it. We're not buying it. Look at this. Look at this area. This candlestick right here, big as it is, leaving a clear space. Now that space right there, we want to mark that space. Look, we came all the way back into the imbalance drop. One more time, look around this area. Look at this space right here. Let's fill that space with a box. Look at where we came back to. Came back into the space, fill it, and we dropped. It's not a manufactured game. Look around that same area that I marked out, this same area that I marked out. If I should stretch it out, and why do you think price came back there? I want to show you. I want to prove it to you. Did we have a perfect fill around this area? Do we have a perfect fill around that area, guys? And because we don't have a perfect fill, look what happened next. After some time, price started to come back and do a perfect fill, and after the perfect fill, drop. And when it was dropping, look where it finished. Another imbalance. There. See there? Oh my God. I'm not treating institutional candlesticks, so I don't want to be going there yet. Let's just pay attention to imbalances today, and that alone is just going to blow your mind. You're going to ask yourself, why have I been losing so much money? Why are my trades not going so good? Did you not know this? You see, from all the things that we've learned from yesterday, put together with this, you're done. You're done. And look at this. We filled it. We filled this imbalance perfectly inside this area where we think the imbalance is. Look at how price came back in, bought. Came back in, filled it perfectly and bought. We filled it completely and we rose straight up. It's not a game, guys. It's not a game. It's just what the market does. And all these areas of imbalance are just waiting for another day to be filled. All these areas are just waiting for another day to be filled. It's just about identifying which area in the Elliott wave, which area in the market structure you are sitting in order to play the correct imbalance. Don't just pick and choose any imbalance and tell me, Francis, I've been taking the imbalances, but you know I'm still hitting stop loss. Of course, you need to be able to identify the trend. You need to know what trend you're in. You need to know, am I in a corrective wave or am I in an impulsive wave? You need to know all these things. And these are the confirmations I've already given you prior to this lesson. It's just a confirmation checklist I've given you. Line up those confirmation checklists as to how we've studied. Which one comes first? What do I need to know first? Do I have this? Do I know the trend? Is the trend going my way? Am I in a corrective wave? Am I in an impulsive wave? Okay, if I'm in an impulsive wave, I'm going to wait for the corrective wave. A corrective wave must give me that 50% and above area So that 50% and above area, do I have an imbalance sitting where anywhere above that 50% area? I'm going to be waiting in that area for price. That's it. You're done. However, you need to understand that the wave is always going to be in this shape. 1, 2, 3, 4, and 5. Once 5 is finished, the next thing you need to understand is a break, is a sweep of liquidity. You need a sweep of liquidity and price will reverse. And in this area will be a Wyckoff, which we'll treat. You might be wondering why price came down here. Look, we did a big move up in price. Why is price coming down here? Look around this area. Let's zoom in and show you something. What is sitting right here? What is sitting right here? Imbalance. Let's boost it a little bit to the left side and see. And look at that. We came back, filled the imbalance, and boom, is a buy. Why is price coming back down again? This wick is touching that wick. How about this wick? We need to mitigate this wick and go away. If this wick mitigation does not happen, after some time, price will have to come back and mitigate it and go. Is the common language of the market. I know questions are going to start flying in. Does this happen on every pair? Yes, it does. Even the fastest moving pairs, it still happen on them. Look around this area. Once again, look around this area. Imbalance all around there. Price came back, filled the imbalance, and a drop. What do I mean by mitigation? It's just the term which explains price coming back to touch the wick. That's all. In a layman language, let's put it that way. When we get to smart money, we'll talk about mitigation properly. For now, let's just stick to market structure and the common nomenclature of market structure. How is everybody feeling after this session? All right, so somebody's asking, should we stick to higher time frame? I want to show you something right here. I'm going to put a box around here and I'll show you what happened inside this box on a smaller time frame. Inside this box is another wave. Even though we saw it as one-legged on the other end, but inside that box is another wave. So inside a higher time frame leg, you could be trading on a small time frame basis to catch the legs. You could be trading on a smaller time frame basis to catch the legs. Look around this area. Imbalance happened here. We came back, filled the imbalance, fully drop. Again, we came back up, fill, drop. It's the same story over and over and over again. Imbalance right here. Price came back, mitigated, boom, up. So it don't matter what time frame you're in. That is the reason why it is essential for always knowing what your higher time frame is telling you. If you know what your higher time frame is telling you, then you can take a reasonable amount of trades on your smaller time frame. Knowing that the trades that you're taking is going in accordance as to what is happening on the higher time frame. So if I'm working with a 4-hour time frame, I want to go onto a minimum of probably 30 minutes time frame and pick one leg and see what is happening inside that leg. All right, for example, let's take around this area from 4 to 5. I want to go on 30 minutes time frame and see what is happening there. From 4 to 5, look at that. 1, 2, 3, 4. Now we have our 5. B, C. Did I create this, guys? I didn't. So inside that very 4-hour trade that you're looking at, one leg, inside that leg, there is another leg on a smaller time frame where you can trade. And look at where price reacted from. What is here? Imbalance. It was all sales around this area. We came back. Let's pull our fibs and see. 50% and above inside the imbalance area, and price dropped. Over and over and over again, there is an imbalance sitting here. If I should stretch my fib, you see around, we came back to fill it, and it dropped. Over and over again. It goes on, even inside this area. Look what's happening inside that area. Nice waves going inside there. Oh no, I picked the wrong one. Let's delete this. Let's finish our 5 here. I'm sorry. Inside that small area, look at what happened. Another wave. And what were the confirmations? The same stuff, same stuff. What is sitting here? Liquidity sitting here. In smart money, we'll talk about this. In smart money, we'll talk about this. And this gave the drive for price to come up. This is the reason why price had to drive up. And where did price drove into? Imbalance fill. And when it was approaching the imbalance fill, look at the shape that it gave us. It gave a specific shape. And if you look on your RSI, something crazy is happening on there. Some of you are probably familiar, some of you are not. So when price is approaching your imbalances, you're always going to be seeing some of these confirmations around. Equal highs sitting everywhere, imbalances sitting everywhere, this kind of shape sitting there. Sorry, can you go over the red line, ABC? I get the 5-point Elliott wave. Can you quickly explain? Is this a corrective wave after every Elliott wave? So after every Elliott wave, you get to have that corrective wave before another wave continues. Does that help, Lloyd? Even on the smallest time frame, you're still going to be seeing the same stuff. Let's go on 1 minute time frame. I want to show somebody something. 1 minute time frame. Look at this leg right here. Five. Yes, there are fib ratios to the legs, which I don't want to go. I don't want to. It's not important really, because you're not going to have them pitch perfect. If I should pull a fib from here, usually the first wave is around 38.2. The second wave, if you pull it from the 2 to 3, is around 61.8. 50%, 61.8 area most of the time. That would be the range for the 2. And then your fifth wave finishes with the B coming in. So almost your 5 to A is almost going to be as equal as 1 to 3 or 50%. It's got fib ratios to it, but I don't see how important those ones are. They're not really necessary. It's about knowing the how do I explain this? Identifying the qualities of the waves that I've given you. Is it an impulsive wave? Is it a corrective wave? How fast is that wave happening will determine which wave is being formed. And it's everywhere. Even in 1 minute time frame, you can see. Look at that. Look at that happening. Look at that happening here. Can you show an example on GJ 4-hour? I don't know. I have lots of things marked up on my GJ. Let's choose a different GJ because I don't want to mess this one up. So on GJ right now, look at the very base of the GJ. Has that answered your question, Lloyd? I'm just treating market structure, fully market structure, nothing else. Have that answered your question? You can clearly see it. Does the final ABC show you what direction the market could be heading next? Yes, it will. If you're in an uptrend, the ABC is always going to give you a directional bias, which will pull you into a sell. If you're in a downtrend, the ABC is always going to give you a picture that will put you into a buy. And the ABC is going to create your Wyckoffs, the distributions and then the accumulations. All right, so guys, I have less than 3 minutes on this call. I will be finishing today's sessions. If you have any question, please feel free to ask. And let's talk. Feel free to unmute yourself and let's have a little bit of a chat before we go. Come on, I'm going to pause the recording now.